invite Kashyap Javeri. He's from Emkay Investment Managers, joining us this afternoon to give us his view on the market. Kashyap, great having you. Let me first start off with what is it? How are you positioning yourself for a market like this? You know, you see IT down 2 days and up the third. How do you play a market like this at this point of time?
So, thank you so much for having me on the show.
Very good having you.
We have been dealing with volatile markets now for almost about probably more than 24 months. Primarily, I would just like to draw attention to one data point. Probably the all-time high of Nifty 50 that or Nifty 100 that we saw is now today almost about 650 days away, right? So we have been dealing with this volatility for quite some time. How we are dealing with it for our client portfolios? Our approach always has been, bottom up. We usually look at the stock and then, probably where we are sector agnostic, we are market agnostic in the sense that we are quite flexible in terms of market cap as well as the sectors, and try to pick winners first and then probably look at what sector or what market cap they belong to. In fact, probably quite a meaningful proportion of our portfolios was tilted towards mid cap for almost about last 18 to 24 months. And despite whatever has happened in the market, that part of the portfolio has done reasonably well. So I think, we have been dealing with volatility. If we are going bottom up in terms of our research and stock picking, we will continue to take that volatility in our stride.
I'll just quickly mark out ITC Hotels, a very strong set of numbers at the outset, 180 crore, 35% growth on the bottom line. Even the margins have come in better on a YOY basis, 31% versus 30%. Revenue has gone up 15%, so operating efficiency playing out, but it's getting sold into quite sharply. Kashyap, I wonder, you're a bottom-up stock picker. ITC Hotels, there's been, since the time it got demerged, there's been a lot of fluctuation on the stock price, right? It's fluctuated between 150 rupees and 250 rupees. There's been huge fluctuations. How do you look at this story more from a medium to long-term standpoint, right? Maybe you don't talk stock specific, but just give us the sense as to how would you look at a stock like this or the sector as a whole and the kind of story that's playing out within hospitality.
So I think I would probably, rather than just looking at hospitality, I would probably comment on the whole discretionary spend as such. And I think most of the numbers that we have looked at in probably first half of this calendar year, whether we look at the payment indicators like, UPI payment indicator growth, or we look at the generally electronic payments growth, if we look at the same store sales growth for a lot of these, value retailers, as well as probably high-end retailers like Phoenix, as well as I would also point out to the fact that if you look at generally the box office collections, where ticket prices I would assume are slightly middle to upper middle class kind of consumption item, they have seen a fairly strong growth in the H1 of this calendar year. We do expect that discretionary growth or growth in the discretionary spending ideally should continue in slightly medium term future also, and in that sense we are quite bullish on discretionary spend items across the board, and that's how our portfolios are also today aligned.
Okay, and Kashyap, you typically suggest that you have to start buying chaos, right? Because that's where the value really lies, and therefore, would IT be a buy at this point of time? Would you buy that kind of chaos, or is it just too much chaos in that particular pocket?
So I think the way we are looking at IT today is that the value has the derating both in terms of time as well as overall valuations has created significantly deep valuation cuts out there. Generally, if you look at probably even some of the ETFs within that space, I think dividend yields could be in sort of a fairly good single digit number. So yes, we do see a value there in terms of sector. Having said that, our broader view is that overall earnings, probably even if there is no threat coming from AI or probably any other kind of broad macro threat to that particular sector, overall earnings growth could be constant to, probably a low double digit, not probably even 10 digit, but I would say a low double digit kind of growth number. India is a growth market, right? People seek growth when they look at India. And in that sense, while there might be probably initial some bit of up move because of the deep value that's been created, I think if you're looking at a fairly long-term value creation, I think plenty lies in many of the other sectors available on the exchanges.
Don't touch IT at this point. Would Kashyap, I wonder whether mid-tier IT stocks, which are actually growing, I mean, it could be mid-teens growth, trading at 35 times odd, but would those interest you at all, or would you stay away from that pack as well?
So I think at this point of time, our portfolio weights are aligned in line. We are not overweight out there. It's largely in line, just marginal bit of overweight. But I think for the time being, we are quite happy with that. Not going anywhere beyond where we are.
Point taken. Viewers, I'm going to have to take a pause on this conversation. It's very difficult to leave Kashyap without asking him his take on banking, by the way. He's traditionally a BFSI analyst. So tough to let him go without asking him banking. We'll quiz him on that on the other side. Stay with us. Welcome back. We're in conversation with Kashyap Javeri of Emkay Investment Managers, and he was of the view just prior to this break, you stay away from IT at this point of time due to lack of growth. On the mid-cap side of things, neutral, because there is some bit of growth. Kashyap, talking about, therefore, sectors where there is value, right? I mean, how should one look at banks, therefore? Some of these banks were trading at 3-4 times book a couple of years back. Book values have compressed and valuations have compressed really substantially from that point. But when you compare them to some of the larger banks and, globally, they're still trading at a premium. I know it's not the right way to look at banks, especially in India, given that there is growth. But what's the right way to kind of rationalize that your PSU banks are trading at 1 time, and then you've got some of your private sector banks trading at 2 times, growth largely the same. ROAs are obviously slightly different. But growth, in fact, for private is slower than PSU in most cases for the last couple of years.
So I think let's dissect this into 2 parts. So you rightly said that, if I look at global banks, obviously we are still at quite a premium. And having said that, but if you look at the dissection of the growths, while our banking as a space has been largely about banking and less about, or rather commercial banking, and probably less about everything else, I think it's not strictly apple to apple comparison out there. Between the PSU and private, I think if you look at broadly the growth drivers which impacted probably private banks until now was one. Obviously, there has been some bit of competition which came from the PSU banks in last about 3 years, that PSU banks have been repairing their balance sheet, and consequently it gives them some bit of leeway to grow the balance sheet now. But a fairly large part of that earnings was also sort of driven by the fact that their legacy NPLs were sort of reducing. They have been completely provided for, which means your provision line items were reducing. And point number 2, if you look at the breakup of the return on asset, a fairly large part of that ROA also came from recoveries which happened from the total return of account. I think both these earnings driver for PSU banks have faded considerably. Whereas if I look at the private sector banks, what's working in their favor is one, their market share in deposit is still rising, though not at the same magnitude as it has been in the past. Secondly, if you look at the margins where their book were largely linked to external benchmark, now that impact of reducing external benchmark is already in the margins. And point number 3, if you look at generally the credit growth in the bounce back now in the fourth quarter, what we are seeing is that the private sector banks have started growing marginally now faster than the PSU banks. If I look at overall valuations, obviously when I'm looking at 1.6, 1.8% ROA, which are core, versus 1% ROA for PSU banks, where almost about 20 or 30% of that ROA is actually driven by the recovery in the technically return of accounts, as well as some bit of provisioning, that saved because the overall NPLs were not rising or either declining. I think it's going to change in favor of private sector banks as we go forward. So I think that valuation gap between the private and PSU banks, which has been still there, I think it needs to be, there, taking into account the fact that core earnings are materially different for both of them, much more pronounced for private and much less pronounced for PSU banks. I think we do believe that there is significant value now available in the private sector banks. That's where our money is also, lying in some of our strategies at this point of time. But our favor at this point of time would be more on the private sector banks, plus even NBFCs for that matter, versus, let's say, PSU banks.
Very clear, Kashyap. I'll talk about banks before I go to NBFCs. So, again, on the private sector banking side, would it be the larger ones? Would it be the smaller ones with faster growth? Given that there's asset quality improving, at least in terms of a trend. We were speaking to Jana today, and they were also suggesting that if 45 bips is our credit cost quarterly, of course, in the current quarter, then you can imagine what our full year credit cost will be. And this is the worst quarter technically for someone like a Jana. And therefore, that was the kind of guidance that he has given us. Give us your sense. Where do you sit at?
So our decision making in case of BFSI, and this includes both banks as well as NBFCs, it starts from the start point of that is, where particular bank or an NBFC is able to raise money at the cheapest price, and that's the starting point of any decision that we make in BFSI as a space, as in totality. I think in that sense, we do believe that private sector banks, in particularly in large space, have been chasing away market share yet from many other peers, both including public as well as private. I think that's going to continue for at least, we would say, anywhere between medium to slightly long-term future. That's something that's going to continue to happen. So that's where our some of the strategies have quite a bit of exposure. We do also like some of the mid-cap banks, particularly where we have seen that some of these banks have been able to get away market share in deposits from the PSU banks within their respective geography, because many of these mid-cap space are more geographical concentrated in their operations. But we have seen some of them doing quite a phenomenal work on the deposit side. So we have about a one or two names in the mid-cap, or let's say very old gen private sector banks also. So that's how our banking exposure has been. At this point of time, I think in terms of PSU banks, we do not have any any much exposure at this point of time.
Okay. And Kashyap, how should one look at the manufacturing space, given everything that came out in terms of the outcome from the cabinet meet yesterday? Do you believe that it changes things materially on ground? Because some stocks have really moved, but just your sense from a slightly more long-term kind of perspective?
So I think if you look at broadly the actions of the government since last about 5-6 years, they have been tilted more towards manufacturing space as such. I would actually compare this last 6 years with the period that we saw for banking between 98 to 2002. You had plethora of RBI regulations which came in. You had significant amount of IPOs which raised money for a lot of these PSU banks. In fact, even they had private placements which jacked up their the capital when they were in the miserable state. The overall change in the capital structure as well as the way these banks were functioning, we saw that whole bull rally in terms of BFSI between 2002 to 2008 or 2010. I think manufacturing is at that sweet space at this point of time, where the focus of either the regulator or the the government or the manufacturers themselves is razor sharp on this particular sector as such. We have showcased that in terms of automobile and auto ancillary in last almost about 30 years. We have shown that in case of electronic electronic manufacturing services in last about 6 years. We are, probably I would say more than today in terms of B2C or D2C, or within that the whole chain of B2B2C. I think we would be more inclined towards B2B at this point of time rather than B2C. So I think manufacturing probably for next 10-20 years, I would see that anybody who is in the formalized economy, whose vision is fairly big, and has ability to execute, I think that's where the most money will be made. I think as a corollary, what one can look at is that, recent report by UNCTAD also tells us about how FDI is moving in this country. And versus a very meager or miserable share of FDI, which used to go to manufacturing probably 5, 10, 20 years ago. Today, the share of manufacturing is now, probably neck to neck with services in terms of inward FDI. Yeah. So I think our, inclination at this point of time on B2B is fairly high.
Thank you so much, Kashyap, for joining us and giving us that perspective this afternoon. We've had a very meaningful conversation. Thank you.
Thank you.